Welcome to the November trade floor update. Welcome, Adam. Well, I think it's important to jump straight to it. There's been a lot of volatility within bond markets over the last few weeks, particularly within the front end of the yield curve.
Yep.
My sense is that it's largely gone unnoticed by many investors. Can you walk us through what exactly has been taking place?
Yeah, so there's a couple of there's global factors at play and some local factors as well. So on the global front, we've seen more persistent inflation, elevated levels of inflation from supply bottlenecks that hang around longer than expected. And this is just seeing central banks starting to bring forward guidance when they think they'll need to raise interest rates. So we've seen quite an abrupt rise in global interest rates at the front of the curve. So maturities of bonds, sort of 1 to 3 years, that type of maturity structure. And this has seen some abrupt rises globally. And then when we look domestically, this has really challenged the RBA's yield curve control tool. So you can remember, in terms of their policy settings, they have set the cash rate at 10 basis points and then anchored 3-year bonds at 10 basis points by purchasing them in the market. This rise in global rates has really challenged that policy tool, and RBA abandoned it and haven't been in the market buying bonds. So that really abruptly moved our front end rates higher as well. So a bit more persistent level of inflation, rising global rates at the front of the curve, and the RBA abandoning their policy tool has really seen elevated levels of volatility over the last couple of weeks.
So with all that in mind, big shift in the front end of the yield curve, particularly here in Australia. What are the key takeouts for investors? What do they need to be thinking about today?
So I think you have to step back from the noise, the daily noise and volatility a little bit, and think what's changed and what hasn't. So what's changed is we are seeing more persistent levels, more persistent inflation. It's not to say we're entering a period of breakout higher inflation, but certainly the transitory elements are taking a little longer to wane than many expected. And central banks are starting to bring forward their guidance on when they lift interest rates. So those two things have changed. Take the RBA, for example. Previously, they were saying they didn't expect to raise interest rates until 2024. Now they're saying that might happen in 2023. So those things have changed. What hasn't changed is our expectation on the destination of interest rates, so where we think they can get to. So our new neutral expectation, so the new neutral being the neutral level of policy rates around the world in developed markets, where we think the cash rate will average going forward, as an example, hasn't changed. We think in most markets it's somewhere around 2%. Thinking the US, Australia, Canada, New Zealand, some a little higher, some a little lower. So when you look back at the interest rate moves of the past couple of weeks, that's largely priced now. So I think the punchline for investors is that the hiking cycle in many markets is now priced, or largely priced. And you don't have to reach for yield to generate, or reach into risky asset classes to generate healthy levels of yield and income. So core bond funds now, many yielding north of 2.5%. So reasonably attractive. So in that context, in some of those markets that have repriced, we've been adding duration, taking advantage of higher levels of yield, and we don't think investors in general have to reach into risky asset classes for income anymore.
Well, thanks, Adam. We've just published our latest secular outlook, The Age of Transformation, and there you'll find more details on the destination for long-term interest rates. We bid farewell to the new normal, but hold on to the new neutral as well. For now, have a great week.